Good morning, everyone. Welcome to the monetary policy session here at the Milken Institute. My name is David Zervos. I'm the chief strategist at Jefferies, and I think this is my 5th monetary policy panel at the Milken Institute. And I thought I'd start before we kick it off with our guests, reading you some of the titles of previous Milken Institute monetary policy panels. In 2012, we had Twist and Shout, the limits of monetary policy. In 2013, it was Central Banks, is quantitative easing becoming quantitative exhaustion? 2014, Monetary Policy, Forward Guidance on the World's Central Banks. And then in 2015, there actually was no monetary policy panel, so there was exhaustion setting in on monetary policy at the Milken Institute. And of course, in 2016, you guys are all here for monetary policy out of ammunition. So there's a slight trend, I would say, in the Milken approach to thinking about monetary policy, which is that it's coming to its end, and it doesn't ever seem to be coming to its end. And I thought I'd spend 1 minute on a story with Mike to give you a little bit of insight into how I think monetary policy at this conference is discussed and viewed, at least from the perspective of someone who's been coming here for a number of years. And I was asked to speak on a panel with Mike at his London conference, at his credit panel, which is usually his flagship panel. And he had on there the titans of credit, in my opinion. He had Tom Fink from Babson MassMutual. He had Scott Minerd from Guggenheim. He had Leon Black from Apollo. And he had Mitch Julis from Canyon. And as we were walking up, I said, Mike, you know, I'm Dave Zervos. I'm the strategist at Jefferies. I write about central banks. I started as a central bank economist at the Fed in the early 90s. Traded some macro at a couple of hedge funds. And here you have me sitting with some of the most amazing credit traders in the world, all CIOs. It's sort of a testament to how important monetary policy must have become to the credit investing, to the investment process in credit. And Mike looks at me with that Mike Milken grin on his face, and sort of fatherly grin, but you know he's about to say something that's really gonna sort of probably pick your pocket in the end. And he says, that's not gonna last very long. So. What I think about monetary policy here at the Milken Conference, I do think of us a little bit as a sort of unwanted guest, something that's entered into the investment process that people had hoped would go away, but just doesn't go away. So here we are at the out of ammunition phase, and we're going to talk about what's next for monetary policy and hopefully give you guys some guidance in your investment process and your thinking about investments on what monetary policy has to influence that and also to hopefully maybe even give you some ideas on how to capitalize on that in your portfolios. I have a number of questions that I prepared, and I think our guests know. I'm not going to go through and introduce everybody, but I do have specific questions for each of our guests that I think are appropriate to some of the things they've been writing about or talking about in books, on Twitter, or in their own outlets for discussion. And the first question is for Joachim, and I know we've talked about this a lot, Joachim. And the idea here is going to be to get the question going with one person and then open it up rapid fire so people can come in and kind of debate it. For the last 18 months, Joachim, the dollar has really been a centerpiece of investing, and it's been, since the end of the taper and the beginning of liftoff, a big dollar strengthening move that seems to have hit a wall in February. That dollar strengthening move probably caused a lot of consternation in this room for emerging market investors, commodity investors. We saw some nasty maneuvers in markets in August of last year, for example, and in January of this year, a lot attributed to this dollar strength, which fed back negatively into both of those markets and then ultimately into all markets. And there seemed to be a pivot right around that G20 Shanghai meeting, where all of the central bankers, or the major central bankers, seem to have pushed a policy which is something a little less dollar positive, and the dollar has weakened quite sharply, giving a lot of, I think, breathing room to both commodities and emerging markets, and even our major equity markets and credit markets. Do you think, Joachim, there was some agreement at the G20? And if there was, how would that happen? Or is this just a confluence of everybody recognizing that dollar strength was feeding back negatively into their own individual economies?
Well, David, was there a Shanghai Accord or a Shanghai Co-op, as I like to call it? Well, we don't know. One of our panelists knows, but he probably won't tell us. But I'm pretty sure that there was a discussion about the negative impact of last year's dollar appreciation, a discussion about the unintended consequences of monetary policy divergence, right, which we saw playing out last year. It pushed the dollar higher. It created problems for many emerging market countries, or the debtors in emerging market countries who had taken up a lot of dollar debt. It created a problem for China, as we learned on August 11th of last year, when they devalued the currency. So whether there was a deal or not, we don't know, but everybody who was in the room has behaved as if there was a deal ever since. So the Fed became a lot more dovish. The BOJ was reluctant to push interest rates further negative. The ECB focuses much more on credit easing now rather than pushing rates more negative. So they all behave as if there was a deal, whether there was one or not. And since then, things have calmed down. And I find it quite interesting. That's the last thing I'll say. You know, we're discussing whether monetary policy is out of ammunition. And a lot of people in the markets claim that, you know, we've come to the end of the power of monetary policy. But everything we've seen last year and this year shows that monetary policy still is very powerful. It was the mere talk about rate hikes by the Fed last year that caused a lot of problems, right? And then when the Fed turned more dovish in February, March, things have recovered and financial conditions have eased. So that tells me that monetary policy and even sheer talk rather than action can still be very powerful.
Hence another monetary policy panel at the Milken Institute. Pippa, you, I know, would have some thoughts on this. And Governor Pelosi, I'm not going to ask you about this, but feel free at any time to interject. I have a question designed for you next, but you're more than welcome to interrupt at any time.
Okay.
So my career started working in the White House with the Plaza Agreement in 1985. So as a kid, I'm sitting there and listening. The dollar was already falling when everyone said, we should really have the dollar fall. Agreed. You know, what is your power when you sit in the West Wing or over at Treasury? You don't control all these aspects of the financial market. Does it matter that Janet Yellen says, yes, we see clear signs of improvement in the economy, but we have at least 5 million reasons why we can't raise interest rates? Then the dollar stops appreciating. Surprise, surprise. So this idea that there's a cabal and a decision to set the price is actually quite a dangerous notion. And it comes from the fact that we have been in an environment where we have thought central bankers can control interest rates, can control the value of the currency, can control all these outcomes, which leads to jokes from the Chinese. Who's more communist now? Seriously. The level of intervention that we have, I find quite extraordinary. And to finish on our key points for this panel, always the topic is, have we run out of ammo? And I'm like, since we're here in LA and we appreciate films, remember that film, The Hangover, where the guys have taken a ton of drugs and they go, they're not working. So they take more. Are we in that kind of environment where we start to see the signs that the US is doing better, that there's some signs of bubbling up of higher prices in the economy, and we go, we need more?
There's some great analogies on the medical front, I think, with QE and potentially even with debt. So we could talk about that with the next question on fiscal policy. But in a way, Pippa, I think your answer to this question, if I'm reading it correctly, is that it was, in your opinion, in the best interest of the U.S. to fight dollar strength. That worked out better for the U.S. It was certainly in the best interest of China, given their link with the renminbi, to see dollar strength stop, so they didn't have to go down this complicated devaluation path. I think that the problem that I have is, why is it good for the Japanese and why is it good for the Europeans? The dollar yen is at 105 today. It was 123 late last year, and or in Q4 of last year. And the euro, I think, touched 116 today after hitting a low of 105. We are seeing the Europeans and the Japanese embrace currency strength at a time when a central banker would probably be looking at as a tightening in financial conditions, and certainly not something that is getting them to their final goals of 2% inflation and higher employment levels.
So what you've just described is a wonderful image from our perspective in the industrialized world. I think what really matters is what's the Chinese, the Russian, the emerging market, South African perspective, which is they're feeling that the US has made the decision to allow the inflation rate to go higher than its target, because we've been below average for so long. We should go above average for a period. So even though our economy strengthens, we don't act. They perceive this as we export inflationary forces into their environment. Now, the Fed would say, you guys are crazy, just raise your interest rates if that's the case. And they're like, are you kidding? Do you know how much pain we have already taken and now you want us to tighten the belt? No way. And so this disconnect from how it's perceived in the emerging markets versus how it's perceived in the industrialized world is such an impasse and almost can't be repaired, in my view. And so we can't be surprised that we then begin to see the emerging markets behave much more aggressively, not just in the context of economics, though, but I would point out, I don't know, how many of you have heard about the One Belt, One Road strategy, OBOR? Almost no one in this audience. How incredible that we go from a world where the Chinese say we take all the savings and we put it into your treasury market, which systematically pushes down your interest rates and lets you buy bigger houses, have a better recovery. Forget it. That's over. You say you want higher inflation, that's a default on us. Now we take the money, we build bridges, roads, physical infrastructure, special economic zones abroad, and that is our future. This has huge implications in terms of capital flows in the world economy, which is a much bigger story than where are we in dollar yen.
Couldn't agree more. But I go back to Joachim's point that everything seems to have turned and hinged on this stoppage of dollar strength. And I wonder if you want to weigh in a little bit on that.
The fact that we're sitting here wondering if there was a G20 agreement means there wasn't one, because if there were, it would have been communicated to the market, because that's the most effective means that central banks have to influence FX markets, is to talk about it. And them not talking about it and going about it some other curious way means that there was no, I think this is, I don't know if it's wishful thinking, but it's people reading far too much into the fact that there's a G20 meeting and then exchange rates moved in a certain direction. If there was no discussion from central banks, there was no initiative.
So I'm going to keep this in the sort of John McLaughlin tradition and always give an answer at the end very quick. Yes, there was a détente agreement. We're done with that question, unless the governor would like to interject. And then I have a question for you on the various monetary policy tools.
Well, I will interject. I mean, the language around exchange rates at the G20 communique was excessively clear. It was very, very clear. And so, of course, we always talk about exchange rates, but I'm certainly not going to comment on your core question. But we are in an environment where exchange rates are going to move. There's a lot of divergence in economic performance. That's why we have flexible exchange rates, is for this situation. And historically, exchange rates have always moved more than their fundamentals. They're more volatile than fundamentals. So I think the simplest explanation is that one, and it's not really a very sophisticated one, but I think it's probably the true one.
Thank you for that. And I now have another question. I want to turn away to a bigger picture set of issues in monetary policy. We've gone through this concept of unconventional monetary policy creation since 2008. We had forward guidance. We've had negative nominal interest rates. We've had QE, the purchase of government bonds. We've had QQE, which involves the purchase of non-government instruments, private sector instruments, equities, and now and credit instruments, which the Europeans, as Joachim pointed out, are engaging in credit easing for the first time, although it's been around. If you look at the portfolio of tools that the Bank of Canada has, or any central bank has, and you think about what we've learned on unconventional monetary policy, its benefits, its costs since 2008. How do you rank these tools? How do you think about when it's appropriate or inappropriate to use them? And how do you think we've done just as central bankers globally in coming out of the box and thinking about how best to deal with a pretty complicated set of problems?
Okay, that is a pretty big question, but I think if we start with interest rates, have interest rates lost their power? I think out of ammo is kind of the most general question you can ask. I mean, a lot of people will say to me, interest rates don't seem to be doing anything. Low interest rates aren't doing anything. And I said, well, what if we put interest rates back up to 3 or 4%? Well, what do you think would happen? Is, well, there'd be a recession for sure. Well, okay, those two things can't both be true, right? So in other words, monetary policy is succeeding to varying degrees at holding back something. The forces that were unleashed in the wake of the crisis, many of them are still present. Now, when you get down to where interest rates are close to zero, then you start asking, what else can we do to buttress that? And those tools you talked about are highly situational. We used to think there was kind of a natural ordering for them. You'd use forward guidance first, then you'd kind of thinking about QE or other forms of credit expansion. And then, people experimented with negative interest rates, and that turned out to work and to allow markets still to function. So there was a learning in that. So now we think of it as, well, it depends on your situation. You may want to use several of those at once, or maybe just one of them selectively, depending on where you are. What we know for sure is when interest rates are this low, is the next move in interest rates has a smaller effect than it had when you were up at 2 or coming down, or at 3 coming down. So everything loses some of its power and yet retains an ability to have an impact. And it's exactly the same situation that Keynes wrote about when he said monetary policy loses its pep. This is exactly the place where fiscal policy has disproportionate effect on the economy, for the same amount of effort. And so we all have understood that from our first textbooks, and it's not really that unusual. These other tools, fortunately, we haven't had to use them in Canada, but the evidence is accumulating that they actually work, but they're not going to change the world. They are very incremental types of policies.
So you brought the point of fiscal policy up, which I want to get to in a little bit more detail, but many folks in the central banking world have made the argument that as you do credit easing, as you do more aggressive things with your balance sheet, taking credit risk at the central bank in particular, whether it's in equity markets or in credit markets, you are acting as a fiscal policy operator. And in fact, if you look at the Fed used to remit, I think, about 15 billion or so to the Treasury pre-QE, and in the most recent years, they've been issuing, or basically giving back to the Treasury something closer to 100 billion, which is obviously a fiscal impact for the United States. But there is other fiscal impacts of picking winners and losers, entering into financials versus non-financials, entering into the mortgage market, or as the Japanese and Europeans have done, going into corporate credit and equities. Are we just seeing monetary policy become a surrogate for fiscal policy? Is that really what's happening with these new tools?
No, I would still see them as quite different and certainly independent in a very important way. And that is that if the central bank is saying, we're aiming for 2% inflation and we think we need to try this, this, and this in order to get there, that's the central bank using what's at its disposal to achieve its target. That's quite different from the old days before we had central banks, or when central banks were captive, if you like, or surrogates, when the fiscal authority, which had a different set of incentives, would be trying to expand the economy, possibly in tune with an election cycle, but more likely just to finance things. And that gave rise to bouts of inflation, because they were using central banks to do that. And that's why today we have widespread independence of monetary policy. It's from that historical experience. And so if it is the central bank doing its analysis, saying that's what we need to do, then that's monetary policy, regardless of what tools being used.
Before I open it up, and I know, Pippi, you're dying.
Pippi wants to say
I'm going to
something.
give you one opportunity, and feel free you don't have to answer this one either. But we hear about, ever since Ben Bernanke's speech in 2003, this concept of helicopter money. It's now made it into the mainstream. There are discussions about it. It's an original Milton Friedman colloquialism that got brought out by Ben in 2003. But this concept of monetizing debt, or dropping the money from the sky, certainly at that level, one has to think fiscal policy is being conducted by the monetary authority. So if we go to the the very end game here and think about helicopter money, then we are seeing the central bank enter into effectively a fiscal debt write-off of sorts.
So the theory, which goes back to Milton Friedman, as you say, is true that the notion of there are no helicopters, but so the delivery of that monetary expansion in that theory is through a fiscal channel. However, the notion that Friedman had in mind, and Bernanke as well, is that it again is the central bank saying, in order to achieve your inflation goal, this is what's needed. And then, and so whether you think of it as fiscal or monetary, the point is, what is its objective? And if it buttresses inflation expectations, then it's doing its job. Keeping those expectations anchored is what gives policymakers the room to maneuver, stabilize our economies, and give them better outcomes.
So I think the key thing, though, is the whole point of negative interest rates is to compel you in the audience to stop saving and to go put your money to work on some risky asset. The riskier, the better, because when interest rates are negative, that's the whole compulsion. Now, in Japan, what we see is record sales of safes, personal safes. That is not what central bankers want you to do with their money. So we have a new technology that's now on the table, which I would argue is the next tool that they're going to look at. Andy Haldane and Charlie Goodhart have written about this, which is we should move our society to electronic cash. Not because it's convenient for you, the consumer, but because that way government can basically compel you to spend your money on riskier things and dock you for saving it. Now, this is huge social consequences we have to think about. To your point, can you fix a debt problem by having more debt? Which I think is an open question that some common sense could be applied to. But this is important because people are being very creative about what are the new tools that we could use.
So it's interesting, just on the negative rate story, when Denmark first went, when the Europeans first went, when the Swedes went, there was a widespread belief that it was all kind of working, as you pointed out, that it was having the intended effect. You got rid of the speculation in the Danish krona. The Europeans were weakening their currency, which seemed like a very good thing when it was up at 140, heading down to 120, 115. But the Japanese experience is the one that's got everybody kind of hot and bothered because they did it earlier this year, right around the time of this impasse with the dollar and potentially a devaluation in the renminbi. And I'm not sure if the evidence is yet really that conclusive on the negative rate side, but I think we've had a mixed experience at best in understanding them. And certainly what happened in Japan has probably given most central bankers, I think, a little bit of second thought on negative rates, which is maybe why Draghi's pushed back. I would also add that the interest rate channel in general is a competitive devaluation channel. It's a channel by which I beggar thy neighbor. I don't just bring consumption forward and make investment more exciting for you through the incentives you pointed out, consumption today versus consumption. I also weaken my currency, which hurts my neighbor. The credit channel that Joachim was pointing out earlier is not a beggar thy neighbor policy. It is a policy that just narrows credit spreads, narrows equity risk premiums, and really operates domestically without weakening the currency and hurting your friends or foes. So there is something to be thinking about on interest rate policies versus credit and balance sheet policies. And at least in my opinion, when we start ranking all these up, and negative interest rates maybe brings that to the forefront. I wonder, Joachim, do you have some thoughts on how you would rank effectiveness of these different policies? And of course, helicopter money?
Right. Well, I think first of all, we have to take a step back and think about how did we get into this situation? What's the problem that central banks are trying to solve? And the problem is there's a global savings glut, right, that is depressing the equilibrium interest rate, right? And central banks employ all kinds of tools to try to get actual interest rates towards or below that equilibrium interest rate. That equilibrium interest rate may well be negative. So negative interest rates, it's logical that they came up with the idea, well, maybe we should push actual rates, nominal rates, negative in order to try to get down there, to get down below that equilibrium interest rate so we can support growth, we can bring inflation back up to target. But as we've learned, there are some unintended side effects, unintended consequences from negative rates. I think overall, I think the criticism is exaggerated. I mean, we have to look at the whole picture. Central banks are not only taxing banks for the excess reserves that they hold. Some central banks, like now the ECB, but also the Swedish Central Bank and the Swiss Central Bank, are also lending to banks at negative rates, which is not a tax but a subsidy. And then you could argue through pushing down market interest rates and narrowing spreads through negative interest rates, banks' wholesale funding costs have also come down. So I think if you take a more holistic view, negative rates are not as bad as people say. But having said that, I think QE, particularly when it comes to credit easing, to me is a much more powerful instrument. And I think this is the way forward. If more needs to be done, I think the focus should be on QE in credit and potentially also in equities.
Is that because the interest rate channel has these currency effects that seem to feed back quite negatively, like we've seen in the divergence over the last 18 months between monetary policies in the US, Europe, and Japan?
Yeah, I think it's the beggar thy neighbor aspect of negative rates that I think has raised eyebrows. That's not the only negative side effect, but I think that's an important one. So again, I think credit easing, buying potentially buying equities, as the Bank of Japan is already doing, I think that's a much more effective way. In a way, central banks bought government bonds in order to push investors into the more risky stuff. So why not? But the problem with that is they have removed safe assets from the system, and there is very high demand for these safe assets, for government bonds, for various reasons. So it might be much better to buy the risky stuff yourself.
So I want to bring you into this discussion on thinking about what you think about, I guess, every day, which is sovereign ratings and the like. But the concept of helicopter money and the concept of going to the end game of we're not just buying debt and printing money, we're not just buying equities and printing money, we're not just expanding the balance sheets of the central bank, but one day, maybe in a few years, maybe a few decades, maybe there's so much debt in one of these economies, and I would probably argue Japan's the easiest candidate for this, that the central bank just sort of takes the debt that it's bought out of the marketplace, that it's replaced with cash in the marketplace, and just says, you know what, that doesn't exist anymore. And the helicopter, by the way, it already dropped the money, and you guys all have it, but there's no more debt. How would you think about a sovereign debt rating for Japan if it were to effectively write off half, 3/4, or all of its government debts via central bank purchases?
Yeah, we are getting asked this question increasingly because it looks like some people may conclude that that's what the Japanese are up to by sweeping most of the JGB market into the BOJ. So is that the end game? I don't know, but look, I think from where we sit, QE, no matter how you go about it, weakens the balance sheet of the central bank. Almost no matter how you go about it, weakens the balance sheet of the central bank. And if you're involved in sort of the helicopter drop, then it definitely weakens the balance sheet of the central bank in the sense that you've got a non-performing asset or no asset on the balance sheet, but you've printed the liabilities. So banking is about trust and confidence. Central banking is also about trust and confidence in the financial viability of the institution itself. So I think it raises some fundamental concerns, or could potentially down the road raise some fundamental concerns about central bank solvency and central bank financial viability and the confidence that markets have in central banks. So yes, it looks like a free lunch from a fiscal perspective. The central bank just gives you all the cash, the debt's gone, and so the debt to GDP ratio disappears. But there's a reason we haven't been doing that already, right? We know that's not the answer. So there must be some fundamental issues with that kind of approach, and it really does bring into question, the independence of the central bank, and then that question about the viability of the balance sheet. And you don't want to be reliant on seigniorage profits that, yes, central banks can't go bust because they can always generate profits over a long enough period of time. But that's a concept that everyone in this room might understand very well, but the general public might not, and so it might be a difficult concept to explain to a broader audience that this is actually, this is fine. The central bank balance sheet is weaker now, but there's nothing to see here. And I think that central banks would want to be very, very careful about purposely weakening their balance sheet to that degree. So I think that's where, those are some of the points we would be thinking about in that context.
If it were to happen and you were forced to make a decision on a rating for the government debts of a country, we could even start with a small bit. Let's say we took out of Japan's 250% debt to GDP ratio, 50% is gone. So they still have assets. They still have liabilities. They're still accruing seniorage. They have a negative net worth, as you point out, but there's no shareholders. There's nobody that's up in arms that they're technically insolvent.
The government is the shareholder, but yeah.
But yeah, there's no private sector shareholder. So how do you think about rating them?
Yeah. Well, I suspect that there would be JGBs that are still in the market. They're never going to hold 100% of it, right?
No.
So somebody else is going to be caught up in that process. So somebody's not going to get
And they're going to want a rating.
Somebody's not going to get paid. And I think that...
No, they still get paid. They get paid. It's just those ones are gone.
Well, those ones might not all be sitting in the central bank. That's the issue. There might be some scattered around in the market. We've seen it's difficult to get all...
No, I'm just saying you take a piece of them and you just chuck them out. They're gone. Private guys all get their 100 back.
Well, okay, if private people get their 100 back, I think... it would be a difficult decision for us to make, to be honest, because you could take the view that is all the sovereign. It is, right? I mean, it is at the end of the day, that is all, the sovereign balance sheet. Hopefully, we'll never be in a position to have to make this decision, to be honest, because I think it would be quite a tricky one for us to make. I suspect before we got there, some of these other issues would probably surface.
Can I just say, so this is exactly what the Chinese look at. You guys are basically discussing how are we going to default on the debt.
Yes.
That is what you're discussing. So let's be clear. If you tax Americans 100% of their income, 100% of Americans, 100% of their income, you still have a hole. So that's how big it is. So what are your options? You can tell the world we're just never going to pay you back. That's an Argentine-style debt default. You can say I'll pay you back a little bit later, a little bit less. That's a Greek-style haircut. You can say to the citizens, I made you promises, but I'm not going to fulfill them. That's called austerity. We do that in the UK, but not in the US so much. And option 4 is the one everybody goes for, because when you work in the White House, you know options 1, 2, and 3 are vote losers. Option 4 is inflation. So the Chinese say, how did you guys pay for the American Revolution? On inflation. How did you pay for the Civil War? On inflation. How did you pay for Vietnam in the Great Society period? Every major debt problem you've ever had is solved exactly the same way. That's exactly what you're going to do this time. And by the way, they would say this is the Goldfinger problem, right? Which is in Goldfinger says to James Bond, once is happenstance, twice is coincidence, 3 times enemy action.
But there's something, you have to go back into the history of these. You're sort of raising emerging markets to this sort of sanctimonious
level.
level.
Only because they are our creditors, that they have allowed us to live beyond our means.
But the reason they're our creditors is because their own governments have acted 10 times worse than we have over the last 100 years. The Brazilians were running 65,000% annualized inflation in the early 90s. The Russians defaulted on their debt and moved the ruble from 5 to 30 in a day. And if you go back to China and look at what they did to their people in the 1940s, it is absurd to look at them as a credible central bank or credible government.
Exactly how default works because they have done it.
Exactly, but their point is, what else do they have? Are you going to run to the safety of the real and the renminbi?
No, but it explains.
We got them.
No, but it does explain why the Chinese are the largest buyers of gold.
Maybe we run to the Canadian dollar.
That's why they're the largest buyers of gold, because they go, at least we'll have some hard currency backing. And okay, you can say that's a crazy notion, but it's interesting that we're discussing it in 2016.
But Pippa, where's the inflation? Where's the default?
That's right.
I mean, I'm a native German, so I'm trained to smell inflation.
Of course.
And I've been sniffing around for years. At the beginning, I thought it will happen. I'm German, right? So they're printing money. It will have to lead to inflation. We've learned something. There is no inflation. So, right? The Chinese, the Japanese have printed. The Fed has printed. So far, there is no inflation. If anything, the problem is inflation is too low.
Right.
So I think we should reconsider. This is not about inflating the debt away. Maybe that was the intention.
So interesting.
It hasn't happened. So which is why I think you now need to think about the next step, which is exactly what David had suggested. Well, if you can't inflate it away, well, then you just cancel it. But
Yes.
you only cancel the part that sits on the central bank's balance sheet. This is not a. This
So
is,
you preserve the
default,
rating.
You default to yourself because the central bank is part of the public sector balance
Exactly.
sheet in a broad sense, but it's not a default on all those other bondholders out there.
So interesting that Stan Fisher, the vice chairman of the Fed, has just said we see the early stirrings of inflation, which we want, right? Because we want the inflation rate to go up. But the question is, what's your perception of the reality of it versus what the data tells you? And can the bond market signal it? If the government is the biggest owner buyer of those assets, can anybody be short? I mean, can it really signal anything? So what I find interesting is I come to this Milken conference, and here we know there's no inflation in the US economy, but the only thing anybody is talking about at the bar is the rising cost of rent, the rising cost of my grocery bill, the rising cost of my school fees, of healthcare, of virtually everything that matters. And the question begins to arise, is there a disconnect between what the data point is telling us and what our actual cost of living is? And I see half the audience is nodding their heads. It's exactly the same in China. You can tell the Chinese worker there's no inflation, but the price of their most important foodstuff, pork, is up 50% in like 3 months. So they're asking for wage hikes. The wages have quintupled in 3 years. I mean, Mexico's wages are cheaper now.
There's always
so
going to be great
you can't say they're
anecdotes.
imagining this.
Great anecdotes for inflation. I love the MIT Million Price
Yes,
Index,
yes, it's wonderful.
which just it kind of solves this debate of is there inflation? And the answer from that index is there isn't. It just isn't there. There are certain times where pork goes up, there are certain times where soybean goes down, and we have this wonderful thing called the substitution effect that gets people moving around into different commodities. But I have to side with Joachim on that.
We were talking earlier
the event
about
seems
the new businesses being created.
Yes.
Right? And maybe we should talk a little bit about, because that's a symptom that money is getting to the creation of new companies. 2/3 of the net new jobs are created by firms with less than 50 employees. And that's where I would guess the central bank would measure, is it starting to work?
Is it starting to work? So we all have trouble imagining what counterfactuals we're up against. I picture it as we had this bubble, and it collapsed in 2007, 2008, and we've been in the crater ever since. There's a crater under every bubble. And we're filling up that crater with liquidity. We're trying to row our boat across it. And in some cases, it looks like we're coming up on the beach. And I think the US economy is in that sweet spot. We now have a population of companies in the United States is now growing at about 3%. It's the first time it's gotten back to where it was pre-crisis. All that time it was big negative in 2008, 9, 10, and gradually made its way back up, and now it's up where it belongs. The UK, same thing. So you're getting good job matching, you're creating the new jobs. New companies create most of the jobs. New companies, by the way, create most of the productivity growth when they hit the hockey stick stage. Okay, that's all just free. And the existing companies create maybe 10% of all the productivity growth that we ever observe. It's very incremental. So that sweet spot only happens when you get here. And it just tells us that it's been a long way, but it's actually working. Now, how long does it go before it becomes actual inflation? Open question, because a lot of capacity has been either destroyed or set aside, but we still include it. But you create a new firm with 20 new employees, that's a new capacity out of thin air. And so that's the stage we're at, and we're going to have to watch and see. We can't do the math on this. We have to watch and see and watch those indicators. And, you know, I think those kinds of indexes you mentioned, they're the right ones. I mean, we don't, the folks around here, you know, they're great anecdotes, but they're going to be from specific cities or what have you. They're not a uniform measure of inflation pressure. There's no wage pressures. And that's a pretty important ingredient to an actual inflation process.
So in the spirit of the McLaughlin Group, again, I'll put my last 2 cents on this question and get to the next one, which is that I think I agree fully with Joachim that balance sheet policies that focus on domestic credit and domestic transmission of monetary easing and financial conditions are much preferable to traditional interest rate moves as the method of easing, even though the Bank of Canada did not engage in these QE-like policies because it didn't have to. I think as time goes on, central banks will appreciate more policies that don't involve hurting their neighbors, which are interest rate-driven policies that have the same stimulative effect but hurt the currency. So that's off the table. What I want to go to next is a continuation somewhat of the fiscal question, but away from monetary. I want to talk a little bit about what we think the right solution is for fiscal policy in a world where countries may be limited or may feel limited in their monetary policy endeavors. And there's a number of fiscal Keynesians out there who have been advocating significant increases in debt for infrastructure spending and a movement away from monetary policy. The concept of secular stagnation has become a popular one and certainly discussed inside of Joachim's firm quite aggressively with new normal concepts over the last 5 or 6 years. And the question is, and I'll open this up maybe to start with you, Pippa, because I think I sense the most skepticism of monetary policy coming from you. How would you think about using fiscal policy in lieu of monetary policy to get a better outcome for any of these economies? And what I want everybody to maybe weigh in on and think about a little bit is the answer to our problems more debt? Specifically, should we be going to the Japanese, the Europeans, and even the Americans and the Canadians and the UK and saying, don't focus on monetary anymore, focus on issuing a bunch of debt and going and building fast trains and better airports, put people to work in good highways and bridges? Is that going to get growth going more? Or is the debt itself, is this 100% debt to GDP ratio, 200% debt to GDP ratio, is that actually the variable that is feeding back into the private sector, making people not want to invest, not want to consume, because they're scared to death that their country can never pay it back, so they freeze? So is fiscal the answer over monetary, Pippa?
So the answer is innovation. And the answer is, in my view, the government isn't as good as innovation as the private sector is. So what I would prefer to see is a world in which government was less onerous and invasive on the power of the individual or the company to generate a profit. So we don't have that situation today. We have taxes going up, we have more red tape, we have a more onerous, imposing kind of government strategy. So on the other side, we say, oh, but government has such cheap interest rates, they should build the bridges, the roads, the tunnels, the whatever. Now that's exactly what China is doing with the One Belt, One Road strategy. I find it interesting that local authorities here in the United States, because they are broke, now they're saying, well, yes, maybe we should consider having foreigners invest in our airport link, for example. This is a good thing, right? We want foreign capital to come in and go to work. But the question is, who will do the work? And I have to say, if we're in a world where the US, as an example, is going to have that come onto government's balance sheet, my guess is the outcome will not be as effective as if it were to go into private sector activities in the same area. So this is the critical question, not should we build infrastructure, but who should build the infrastructure?
Let me give you something to think about on that, and then we'll open it up. There is no foreign direct investment going into Japan. None. Nobody wants to invest in Japan.
Yeah, but
and nobody's wanted to invest in Japan for decades.
But it is not comparable to the US.
But hear me through the final bit of the question. The interest rate, the funding cost of investing is basically zero. But as an investor, do you want to go in and say, let's build a new hotel in Japan, let's build a new private sector project in Japan, when there's a big target on your project that says, come tax me to pay off this 250% debt to GDP ratio that the grandparents and the parents of the current and existing generation of Japanese people know was left to them? And I think the source of where I'm going with the question is the debt itself the problem? Is there a Ricardian story here that we are really in a situation where adding more to the debt, even if Larry Summers and Mitch McConnell and Nancy Pelosi can all get in a room and figure out what to do with the cash when they raise the debt and do really productive things, is that debt increase going to actually just make the private sector go, whoa, I can't pay that back, I don't know what to do, and I freeze?
So 2 key points. One, sales of adult diapers in Japan exceed sales of baby diapers. That is why it's not interesting from an investment point of view. That is not the demographic of the United States. And number two, the bottom line is the market will find the capital to invest. And in history, we know the Industrial Revolution followed a period of debt that dwarfed anything that ever came before it. So can we have an Industrial Revolution that will wipe out this debt? Absolutely, and I've just written a book on this whole subject. But the point is,
we grow our way out of it.
We grow our way out, but not if government is like an elephant sitting on your back, asking you to pay more and more and giving you more rules.
Let's ask the debt rater what he thinks about this.
I want to just finish that the previous question we were talking about inflation just for 1 second.
Please.
Which is to find the inflation, just follow the money, right? Which is in financial markets, so there is inflated financial asset prices, not consumer prices and other things, but there is inflation. But on this question, you know, Japan keeps coming up, right, again and again. And if we think about the 90s in Japan and what was happening in Japan and the turn towards fiscal policy to grow, to stimulate growth, and it was all the same kinds of things that are being discussed now, infrastructure spending, and now infrastructure is fantastic in Japan. They built all this stuff, it's great. But what they ended up with was just a higher level of government debt. So they cut taxes to bring tax rates much lower. They increased spending, they increased public spending and infrastructure, and they just ended up with large deficits and large debt burdens. And the reason nothing was happening in the private sector was that there was a deleveraging going on. It did come back to private sector debt, and it was post-bubble, crisis time, which has been an extended period of time in Japan. That's why there's no investment, because corporates are focused more on improving their balance sheets than kind of profit-driven. But while there's a deleveraging going on, it doesn't appear that you will get the kind of response that you would typically get from fiscal policy and fiscal stimulus, because there is this desire to improve the balance sheet in the private sector. I'm not sure if we're there or not. I don't see much deleveraging going on in Europe, certainly in the countries with the high levels of private sector debt. Some in Spain, I must say, but not so much in Portugal
US,
or other.
huge household.
Certainly in the U.S., definitely. That's never happened before, and that was one of the consequences of the crisis. So there has been some deleveraging here, no doubt about it, but not in Europe, where the bigger challenges are private sector Europe. So I don't think we have to really wonder, and you've asked the question yourself: is our debt levels just too high? Is it possible to continue to stimulate, which requires further borrowing, lower interest rates, to increase borrowing again in the private sector? At some point, private sector agents will desire to reduce their debt burden, and debt has to grow more slowly than nominal income in order to bring debt to GDP ratios down at some point in time. We have to accept that.
I guess the question is fiscal policy out of ammunition? I mean, is that the way we should think about it? Or am I just thinking pie in the sky?
I don't think it's out of ammunition. If you can borrow at negative interest rates, at negative real interest rates as a government, there must be projects out there that have a higher return than that negative rate. So I don't think fiscal policy is out of ammunition. But to go back to your initial question, what should be the role of monetary and fiscal policy? I think monetary policy is much better suited most times to deal with demand shocks, right, and demand side problems, because it's much more flexible. Monetary policy can react much more quickly. Fiscal policy in normal times should really be focused on creating the conditions for growth in the private sector. So I agree with Pippa, right? So having an efficient tax system, focusing on infrastructure investment rather than government consumption, that's what should happen in normal times. Having said that, I think there are exceptional circumstances when there is a liquidity trap. It does make sense for fiscal policy in the short term to help boost demand and help monetary policy do the job. But that should be the exception.
Mm-hmm. Do you think of fiscal policy? Is there something that you would wish the fiscal authorities in Canada were doing to make your job easier on the monetary policy side?
Well, the fiscal authorities have just put in a budget which does that. It is expansionary. It does exactly what Joachim was saying. It's focused highly on infrastructure, which they believe is not just expansionary spending, but facilitates growth in the private sector. And I think at the same time, they're contemplating a range of what we'll call generally reforms, that is, other changes, which are things that remove impediments to growth. So this is the third leg of the IMF stool, like structural reform. And often a structural reform, which sounds like some, concept, you're taking away some regulations or simplifying something or getting rid of red tape or having a free trade agreement or something. Internal trade in Canada, for instance. So all those things, what they do is they improve your growth trend line. And what happens is they're fiscally positive. Okay, they create fiscal capacity because as the income rises, your tax revenues go up with it. And so if you need other policies to cushion the blow of the adjustment, they're usually self-financing. And so that's how it is the one thing which is tried the least, in fact. And if we are getting to the point where, yes, monetary policy is a low level of effectiveness. Well, so let's agree with that. It still works, but it's working incrementally less as farther down we go. That fiscal policy, there are places where there's debt, which means you're piling on debt. Other places in Canada there isn't, but still has its role to play. But then there's the third leg of the stool, which in fact complements both of those things and can be extremely powerful. And it's the politically most difficult part, but it's the most rewarding part.
So I guess I'll throw this up to anybody on the panel. Japan has spent the last 26 years taking its debt to GDP ratio from 50 to 250.
Yes.
They've engaged in this massive fiscal experiment.
Yes.
The multiplier back to growth on that has what I like to affectionately been called is a donut.
Really?
That's how I think about it.
So you can imagine
Right.
the counterfactual, David?
So the
Seriously?
counterfactual could be even more awful.
Let's say the counterfactual was this huge 20-year crater, and they filled it up and managed to avoid a depression, let's suppose.
The real question is, can we all sit back and say that the real answer for Japan, which will give us some insight into what's important for Europe, what's important for the US, what's important for Canada, is that Japan just needs to take its debt to GDP ratio up to 350%, or 450%, build even faster trains, better airports, better roads and bridges, and that will be the solution. Because for me, that's a problem. There's something where the out of ammunition story kicks in on the debt side, and people just look at it and go, from a ratings perspective, you know what? I'm going to downgrade that country because I don't know how they pay it back. And if he's downgrading that country, that means everybody in the private sector is running away from that country because it's not a great place to invest. And that's when debt becomes poisonous.
But this is why Japan is a bad example, because where the rubber hits the road is the ability of the entrepreneur to get their hands on that capital that is in the QE and put it to work. In Japan, they have laws. You can open a shop, but it has to be in the middle of a rice paddy where there's no footfall. Yeah. They will not let the oxygen get to the entrepreneurial class.
And Europe is doing a better job?
I think Europe is a little better, but not much. But I think America is great. And that is why QE works in the United States, and it doesn't work in Japan, and why we shouldn't use Japan as a reference point.
Joachim, any thoughts on, is that the right solution, 350, 450? And is that where we're all headed?
Yeah, just a couple of thoughts. I don't think Japan actually pursued such an expansionary fiscal policy. Yes, they've ended up with all the debt, the high debt to GDP ratio, but the main reason is they've had deflation, right? For 15 years, deflation. No nominal GDP growth. That's how we end up with this high debt to GDP ratio. So I don't think fiscal policy was that expansionary. And then to Pippa's point, QE doesn't work in Japan. Well, let's see. I mean, so far, I would say, so far so good, because at least they've managed to move inflation from -1 to +1 on the core measure. That's no small, small piece to do. That was actually pretty good, given how ingrained deflation expectations were. So, again, I think you have to look at it in a little bit more differentiated way.
So I'll end that discussion the McLaughlin way again, and basically say, I think fiscal policy and debt creation at very high levels creates an enormous amount of stagflation and an enormous incentive not to invest by private sector agents, and I would much rather rely on monetary stimulus than fiscal stimulus if I had my choice. Last question, and I want to, but we only have about 5 minutes left. All central banks have been tasked with macroprudential regulation as a part of their mandate in various ways, shapes, and forms. How do people on the panel feel about the regulatory side of what central banks have created since the crisis, and how that has set up conditions for us to be more stable or less stable as we move forward with debt creation, private sector growth, and all the other things that we've moved forward with, I think in a very positive way, over the course of the last almost 8 years since the crisis first started. Are we safer, or are we more at risk with all of these regulations? And anybody please jump in.
Well, you know, you'd have to say safer, but I guess in a world of credit, the only way you can have safety is if there's no lending at all. So it's inherently risky to lend someone money, and that means that there will be periods of time where there's too much lending, or you lend to the wrong person, and someone, really the question is who's going to pick up the pieces after that, and whether it's going to be the public sector or the private sector or some burden sharing in between. But your basic question, are we safer now? Probably we are, but we're never going to be in a position where financial crises, and you know, they'll always be a little bit different next time. But we're never going to be in a position where financial crises are a thing of the past. Just not possible.
Joachim, safer, riskier?
The banking system is safer. The next crisis will not emanate from the banking system, because that's where the last crisis was. So this is what the regulators are focusing on. But I think our ability to prevent crises is very, very limited. The problems will just show up somewhere else.
Shadow banking?
Potentially shadow banking. I mean, everything that's been happening in China shows it's in the shadow banking sector rather than in the banking sector. So yeah.
So I was on the president's working group on financial markets and on corporate governance, and the idea that you could have a group of people sitting in Treasury or the White House who can identify an Enron or a Lehman Brothers before it happens is insane. This is never going to happen. And the idea that we're safer because we have those people thinking about it does not wash in my book. And going further, I think you can make the case that we have more leverage and more risk assets in the system today than we did when we started the crisis. You can make that case. So I think we're all better off because somebody's wearing like a patrol belt and being a safety guard crossing the street. But that doesn't mean that we actually have a safer system.
Governor Pelosi?
I think we're massively safer today than we were before the crisis. I believe we're at the stage now where we're monitoring perhaps unintended consequences, things that we may need to tweak through time. And of course, we don't want to just move all the danger to some other crossing where the kids are crossing without the crossing guard. And so
which is what they're doing.
That's a process. Unfortunately, it's a slow process. Because it's international and needs to be agreed upon. It's not just, you know, some dictator says, here it is. It is a long and difficult process, but I can assure you the system is much safer today. Crossing guards save lives.
I think on that note, I'm going to say two things. One is that I completely agree with Governor Pelosi, and I think with Joachim what he said. The banking system is far safer, and the idea that a bank run of anything like we had in 2008 is easily attainable in the developed market seems almost a zero probability event to me. That doesn't mean that we won't have crises, but we won't have bank run-like events. And my hope is that the Milken Institute will recognize the valuable contribution that monetary policy has made to stability in the markets in the post-crisis era, and that instead of having one of these titles of limits of monetary policy, exhaustion of monetary policy, and out of ammunition, I think Governor Pelosi came up with a title for next year, or maybe the year after. We might have to give him a little time. Just monetary policy, thank you. And thank you all. Thank you for coming.